So for interest rates, one of the big things is to educate why are rates, why do rates move? The best explanation for it is supply and demand. Okay, interest rates are tied to treasury products called mortgage-backed securities. As investors buy those products, the prices go up and interest rates go down. When investors are not buying mortgage-backed securities, the prices go down and interest rates go higher to attract more buyers in. With the pandemic, the biggest buyer of mortgage-backed securities was the Federal Reserve. It was the government. They've been purchasing mortgage-backed securities on a monthly, weekly basis to supply liquidity to the market. The problem with that liquidity pressure that they put in there is that when inflation numbers start to rise, the Federal Reserve cannot continue to do that. So, we started seeing the shift towards the end of last year. It's really compounding now because the Federal Reserve has told markets, hey, we have to reduce the amount of mortgage-backed securities we're buying. We are going to have to increase the federal funds rate, and they threw a little bit of a wrench in the first week of January, and they said we're also going to be reducing the amount of mortgage-backed securities we hold. They're going to be reducing what's called their balance sheet. So the biggest buyer of mortgage-backed securities is exiting the market, and we're seeing that shift towards higher interest rates. End of December, your average rate was probably 3% on a conventional mortgage. Today, it's closer to 3.5%. If we look at those historical trends, we may only have experienced half of the damage that we're going to. These rates can continue to move higher. And if we look at those three historical events of the shift towards higher rates, we would target probably 4% for that top end before we could potentially see a reversal. So for buyers, it's how does that impact me, right? If we look at a $500,000 mortgage, that mortgage is $144 more expensive on a monthly basis today compared to 3 weeks ago. Right? If we go up to 4%, that mortgage is now going to be $282 more expensive on that $500,000 mortgage.